Welcome back. Well, the market has now turned and it's soaring actually. Look at some of the names like Eicher Motors. In fact, this is a fresh 52-week high on Eicher Motors, 3.5% higher on that one. Mahindra and Mahindra as well is pretty close to its 52-week high. So that's the one pocket of the market which has done well, the autos. And of course, the others also making a bit of a comeback. Tata Steel, Kotak Mahindra Bank is bouncing back a bit after yesterday's decline. So let's see what the rest of the day has for us. All cargo logistics is one stock which is in our focus. It's posted good Q1 earnings with multimodal logistics leading revenue growth and losses narrowing in the express distribution segment. To discuss the outlook and timeline of the demerger plan announced late last year, we are joined by V.S. Parthasarathy, Vice Chairman at All Cargo Logistics. Mr. Parthasarathy, good morning. Thanks a lot for joining us. So let's talk about the demerger first, because the state is expecting when is it likely to come into effect? If you could give us some timelines.
Thank you. Thank you, and it's always nice to be on your show. The demerger process is progressing on expected lines. This is a process which takes anywhere between 12 and 15 months, given the way NCLT is working now and the progress that we are making. So we are on target. We already filed the scheme, and we got some positive momentum by dispensing off with some things we didn't need to do. So we expect to finish this by the end of this financial year in terms of what happens. And if it gets delayed, it may spill into April or May, but that's the kind of time frame, March to May.
Okay, so by the end of the financial year, you will this entire process will be done. What will the revenue and margin profile look like of each vertical?
Yeah, so
after the demerger?
Yeah, so basically Sonia, thanks. One of the key things to look at is that we have had MTO, which is a business, the seafaring business, where, as you put up in your chart even, so it's a revenue growth which is 5,600. The 90% of this revenue comes from that MTO business. Now, one of the key factors of the other 10% businesses, in some sense, we said we want to be asset light and so on. While the real estate business, which is the warehousing and the thing, or the ICD and CFS business, they need capital to grow. So we are liberating these two. And when we start with, already Gati's revenue and bottom line, the 90% of the top line that you're showing here comes from MTO. The balance 10% is of the other two verticals. But what would happen as we liberate them, they can become small cap to medium cap and large cap over a period of time. And that's what we are planning to do, liberating the three entities to earn. But when you start, All Cargo will retain most of the revenue. The other two will have smaller revenues, but it will go faster and larger very quickly. And I'm sure I'll have the right kind of investors in each of the company to take it forward.
So will you at any point merge Gati into All Cargo?
So Gati is a listed co, and it remains so at this point of time. There is one announcement, however, which is coming. I wanted to draw your attention, which is in terms of restructuring in Gati. There are discussion going on with KWE, our partner, and one of the discussion is also to buy that stake. And then this subsidiary company will become 100% owned company if it happens. And then some restructuring, which is not yet finalized. Discussions are happening. As soon as we are ready with our mind, with the decision how we want to go forward, we will come back to it. But to reiterate, Gati is a listed co and remains so.
For now, Mr. Parthasarathy, right? What you're telling us is that discussions are on to buy out the partner stake.
Yeah, KWC, there is a subsidiary company under Gati called Gati KWE. And the part of the discussion is to restructure this. There is a listed co, like a holding co, and then there is Gati KWE, which has partnership. It doesn't make sense. It may make more sense to combine operation in one form or the other. What we are saying is that we are in discussion with KWE to buy out their stake in the subsidiary company, Gati KWE.
Right. No, to the question of whether Gati itself will be merged into All Cargo, I mean, is there any...
So I said Gati remains a listed co, and that's what I reiterated. So rest is as soon as we are clear about the restructuring, after discussion with our partners, we may be able to talk more about how the restructuring will happen. But I just wanted to reiterate that it remains a listed company, and that's an important armory for us and arsenal for us.
Okay, sure. Can you give us some numbers? What is the run rate of the MTO business per quarter that we're looking at? 5,000 crores, 6,000 crores. I mean, just some kind of ballpark numbers.
Yeah, so thank you very much. And Sonia, that's a very important question. Last quarter was one of the toughest quarters that we had faced in the sense of what was happening in Ukraine, what was happening in China, and all the kind of headwinds that we are facing. And the rates have also started to soften. In this context, it's very rewarding and very positive thing to note is that we had the highest ever volume last quarter of all cargo in terms of the business, MTO business that you're talking about, 2,338 kbm in LCL and the 137 KTU in FCL. So this is what is the revenue of 5,675, most of it coming from MTO, where all the profit also doubled and the PAT was 2.5 times, etc. And quarter on quarter also, both the yields as well as profitability improved and volumes also improved. So we are in a very good kind of a position, and that in the coming quarters is what we want to consolidate and improve on.
Okay. Can you tell us about the capacity expansion plans that you would have now that this whole demerger process is done? What is the funds that you will be putting to work?
Yeah. So thank you, and that is again, Sonia, a very interesting question, because what we have done is that we had started about 1,800 crores last year, same time in terms of debt. Yeah, I'm happy to say that the debt instead of 4 digits have come to 3 digits in this quarter, with us having about $580 million or 500 crores roughly in our bank. Yeah, and the net debt has come below 1,000 crores, well below 1,000 crores. So we are ready with our arsenal to look for opportunities which will help us scale as we go forward. So we are not saying we do X or Y, but that we have the ability to help all the 3 listed co in due course of time to find their own way. Okay, and Gati anyway, last quarter has done very well to turn profitable already in the previous quarter. So we will hope that we have enough money to make all these guns, all the auto fire on all cylinders, as they say.
Okay, all the best. We hope to speak to you again very soon, but thank you for joining us on CNBC-TV18 and speaking about all cargo logistics. Well, let's move on. Shoppers Stop posted good set of Q1 numbers. Revenues surpassed pre-COVID levels. Internals are also looking quite strong. Customer footfalls have climbed back to near pre-pandemic levels, and the company has also opened 6 new stores in the quarter. To discuss how Q2 is shaping up, we're joined by Venu Nair, MD and CEO at Shoppers Stop. Venu, thanks a lot for joining us. From personal experience, I can tell you that I'm heading a lot more to Shoppers Stop now than I was, say, about a year ago or even 6 months ago, now that the pandemic is behind us. So tell us a little bit about the footfalls, the occupancy levels. Are they completely back to pre-COVID levels, and what kind of growth would you be looking at?
Delighted to be here on the show, and even more delighted to hear that you've been spending a lot more time in our stores. So, long that may continue. In terms of footfalls and where we are, footfalls have been now trending at above pre-COVID levels for a few months, I would say. As you know, we had a good Q1, and that has continued into July and right up to the middle of August, till when the end of season sale was on. So that's been quite strong. But also, I think what has changed and what is important to also bear in mind is that compared to the pre-COVID numbers or pre-COVID levels, we are now engaging much more with our customer, because apart from the footfalls, and if I look at the amount of engagement we have with our customers through our digital medium, we are almost double the number of people that we are engaging with versus what we were doing in pre-COVID numbers.
Okay, so if you can just tell us, what does that mean in terms of revenues in Q1. I think you've crossed your pre-COVID revenues already, sitting on a base of around 950 crores. On an average, what can you do for the remainder of the year?
So while I cannot go into absolute numbers itself, what I can say is that the double-digit growth that we had seen, that has continued. July was strong, and right up to the middle of August, it has maintained that way. And what has been doing well within that, apparel category, specifically Western women's wear and menswear, have been extremely strong. And specifically within that, the casual wear side, whether it's denim, sport, active business, that's done well. Footwear, watches, again, have seen double-digit growth. That's, again, growing very, very nicely.
So you've crossed pre-COVID revenues, right? You said?
Yes. Yeah.
Right. And so what is full year growth going to look like, Mr. Nair?
Sorry, just
what is full year growth going to look like, FY23?
We have a very, very strong plan for the full year number, and we would be looking at a significant growth. While I wouldn't want to get into specific numbers, what I would say is that we would be again looking at strong double-digit growth over the pre-COVID numbers. And that obviously is fueled by two factors. One is the growth engine which we have from our like-for-like stores. But apart from that, also an expansion. And we have planned to open 12 new stores, 12 new department stores, and another 20 smaller format stores for beauty. Of that, we have already opened 6 of them, and hence we feel very confident that we would be able to achieve those new stores as well. So a combination of like-for-like growth plus new stores will lead to strong double-digit growth over pre-COVID numbers.
This is a very broad range, Mr. Nair, you would agree. Could you narrow it down a little bit? I mean, broadly, ballpark.
I mean, as you know, we are a listed entity, and we are not not allowed really to be giving forward projections in terms of where we are, and so that's where we would stick to, or I'll have to stick to.
So since you brought up the beauty business, I wanted to ask you, there's intense competition now from e-commerce players like Nykaa. Nykaa's launching their own B2B vertical as well in the beauty business. You spoke about how you're launching small format stores in beauty, but do you think that's sustainable at a time like this when there's so much competition online?
I think the beauty business and the beauty market itself is just evolving, and it is still in its infancy. If you look at the global scale of beauty versus what we have in India, it is still very, very small. And all the players put together are still catering to not more than 60 to 70% of the premium beauty. Specifically for us, the way we differentiate ourselves, we are in the premium beauty space, and that's where we are very strong. In fact, in the physical retail, we would be the largest retailers that we have. Our turnover in physical beauty pre-COVID itself was over 750 crores, and we are looking to grow on that quite significantly. And given the strength that we have in the beauty business already, and the market itself expanding, I think there is enough room for everyone to grow.
Right, got it, Mr. Nair. Thanks a lot for joining us. That Shopper Stop, the stock has done well. What's doing well is market now. Just look at the Nifty now, up 84 points, 0.5% higher, 17,575. So from the lows, actually, the Nifty is up well over 200 points. 17,345 was the low, 17,340 being the 20-day moving average. And from that point, the Nifty is up 230 points. The Bank Nifty as well, by the way, the level that you spoke about in the morning, 37,950 as the 20-day moving average, that exactly was the low. And from that point on, the Bank Nifty is up about 550 points. So I think today has been a pure level trade, driven perhaps by those algos which were perhaps waiting for this 20-day moving average. We'll take a break. We'll come back and address markets once again and take fresh trades from Mitesh Thakkar. Welcome back. Just look at the market. This really has been a crazy market. It has been for some time now. Just, the market perhaps catches you on one side and then moves on the other side. That's what the Nifty has done today. Mitesh Thakkar is back with us. Mitesh, you did say in the morning that, the 20-day moving average is where you would book shorts. Whether you go long or not, you will let the market's first hour decide that. You have the first hour now. I'm assuming you would already be long. If not, what's your call now on the index and what would be your stock calls?
No, as longs have been initiated, I think, as long as we saw that the morning dip was ferociously bought into, I think, we opened at 17,350 odd levels, and then we immediately started getting past 17,400, 420 zones. I think that was clearly a trigger that in the short term, we might have made one low. And that is what we were expecting. On the stock side, I think BEL has just broken into fresh highs. That's trading buy. Keep a stop at about levels just below 290 here, and a target of 308 can be looked at. The other which I like, other stock which I like is Bajaj Finserv. That's also turning into green and a very strong first hourly price and volume action here. So that's a buy with a stop below 16,200 for targets of around 17,350.
Okay, well, thanks a lot for that. Mitesh, have a good one. Let's shift focus now to the commodity markets. Manisha Gupta is here. Manisha, what's the one commodity you're tracking?
Sonia, I'm looking at the gas prices because here we've seen a constant run-up continuing in this week as well. If you look at the U.S. natural gas prices, they are trading at a 14-year highs above $9.8 per MMBTU. That is the kind of high that we saw in the month of March as well. If you look at the UK natural gas prices, they are trading very close to all-time highs. And the European Union TTF gas prices are trading at an all-time highs right now. If you look at the overnight markets, we've seen a gain of around 15 to 20% for all of these popular three gas varieties that the world follows right now. Well, the reason that you have seen this run-up come in because the Moscow has announced that Gazprom will halt flow from the Nord Stream 1 pipeline to European Union to Germany for 3 days in the end of August. Remember, Nord Stream 1 pipeline is as of now working to a capacity of just about 20%, and 3 days of a complete shutdown to Germany is something that really is working on the frayed nerves already there. And then you have strong demand for the air conditioning in US and Europe. They are dealing with higher than normal temperatures all of this summer. And then export from the Caspian Pipeline Consortium at the Black Sea has been halted. 2 of the Caspian Pipeline Consortium there have been shut as well. So there are concerns everywhere that you look coming in for supplies in case of gas there. And then there are reports for outages at Norwegia and UK gas fields also. So lower supplies, lower inventories. If you look at the US natural gas inventories, those are 12% lower than the 5-year average, and that's impacting demand for air conditioning, demand for winter season, stocking from the Europe. All of that is going to keep the gas prices on the higher side. This is what we've done on month-on-month basis, 13% up for the US gas prices, 154% up on an year-on-year basis. But the European gas prices have gained much higher, more than 50 to 60% on a month basis, and 500 to 400% on a year-on-year basis is how we are trading there. And the street tells us that another 2 to 3 years in case of gas prices, you could be looking at elevated trends.
Okay, thanks a lot for that. The other stock that I'm watching this morning, and we're just topping the charts at the moment, is Eicher Motors. It's hit a fresh 52-week high as we speak, and it's had a great run. I mean, the stock is up almost 35% in 2022 already. It's up 12% in the month of August alone. This morning, CLSA has come out with a report where they have raised their target price on Eicher Motors to 4,154 rupees. And they say that Eicher Motors is the top pick in the auto space. They also talk about how most Royal Enfield customers will come back to buy new bikes within a period of 7 to 8 years. So there are fresh customers expected. If Enfield can capture 80 to 85% of this demand that comes back, volumes will grow significantly. They also talk about how exports is a high growth area for them, and the Royal Enfield EBITDA per vehicle is expected to rise. Currently, the EBITDA per vehicle is at 42,000 rupees. It's expected to rise to 46,500 rupees because of softening commodity prices and better operating leverage. So that is really the big stock in focus this morning. Eicher Motors topping the charts on the index and has hit a fresh 52-week high. The other space we're looking at is pharma. Ekta is here to tell us why she's watching Lupin and Gland Pharma this morning. Ekta, over to you.
Thanks for that. Well, I'll start with Lupin. Nomura has written on Lupin. They've maintained their buy call, but they've lowered their target price to 863 versus 1,098. The stock, according to them, factors in current stress. High contribution from India plus growth markets do provide downside support, according to them. Revenue growth and continued tight leash on overhead costs will be key drivers for margins. They've lowered the target price. Multiple reflects the headwinds in the US business. Goldman Sachs has written on Gland Gland Pharma. They've initiated with a buy and a target price of 2,830. They say that it's a leading global generic injectable player with an addressable generic market size of $138 billion by FY27. They expect a rebound in FY24, modeling a 27% top-line growth, driven by factors such as pickup in the rest of the world markets and India, sales as supply constraints ease off while demand remains robust, improvement in the US core markets business to double-digit growth on the back of new launches, as well as share gains in existing products, as well as increasing production capacities, utilizations at key facilities.
Okay.